Well, the big topic is the Black Friday flash crash on October 10th. People saying they lost 7 million, one person 13 million, and it goes on. Each person has their individual drama. So let's talk about it. What happened if you had a forced liquidation? You didn't plan on it, you had set some stop losses, and bang. What are the tax impacts on that? Well, first of all, did you actually have a loss? You certainly did not realize as much as you were hoping, but if your stop loss was above your cost basis price, then you had made some profit. And if you made profit, then you have to report it on your tax return. And that great unrealized gain that disappeared, you don't have to pay taxes on that at all. You don't get any income either, right? So that's the first thing. If you had a forced liquidation, it depends on whether or not you were liquidated above or below your cost basis, whether or not you had a gain or a loss. What if you had put up assets as collateral for a loan and the value of those assets in the crash went down and you immediately got your collateral got pulled and your loan got terminated? What happens then? Well, when that happens, the income, the money you borrowed is now yours. It's not owed back. The collateral that you put forward has been sold at whatever price it is, and you will have to report a gain or loss on that. I assume it would be most people have a gain on that price, and you have to report down your taxes. The money that was now given to you that you don't have to pay back, that too is now considered income to you. So you have to report that as income on your tax return. The other question, I think this is really relevant, is the wash sale rule. Were your assets subject to the wash sale rule? Right now, technically, no. But there's a law in Congress, in the Senate, that Cynthia Lummis put forward called the Digital Asset Tax Legislation, which would put a wash sale rule in place on cryptos. Well, what does wash sale mean? Wash sale already exists for stocks, and it works this way, that if you sell a stock for a loss, that if you buy it back within 30 days, either before or after the sell date, then you are prevented from claiming that as a loss. Now, this is a big change for crypto investors who have often heard of this topic called tax loss harvesting. Well, this would basically make tax loss harvesting, in certain cases, you would never want to do it. It would be in the case where you're buying it back within 30 days. So if you had a flash crash and you lost a lot of money because of your stop loss, and then you bought it back right away, you would be exposed to the wash sale rule if this law passes. And it's a punishing, in my opinion, tax. Now, I disagree with this proposal. I know Cynthia Lummis, who we all respect, has proposed it. The Digital Asset Working Group from the White House has proposed it. I disagree with it. There is no valid reason why a taxpayer should be burned when they experience a loss like this, or they choose to make a loss. I mean, allow the investor to invest. Why are they trying to complicate it? And this is a very easy law to circumvent, in a sense, as long as you don't buy back on the same exchanges or brokerages, don't even know that the wash sale activity happened. IRS doesn't check for that. So it's very easy to circumvent. And once you've been burned by it, everybody figures out how to avoid getting it done to them a second time. It's a tax on being stupid. And there's no benefit for the investment community or for the government to have that law in place. If a person has genuinely experienced a loss, but they want to continue to be invested in that position, let them do it. I think if there's any tax that's going to be imposed on people, there ought to be a compelling societal reason why that should be there. And there is not one. And if you look at all the explanations on why there should be a wash sale rule on digital assets, you'll never hear one compelling social reason. All they say is, we do it for stocks, we should also do it for digital assets. My answer to that is, why are you doing it on stocks? Get rid of that. All right, so enough ranting on that. The wash sale rule is a stupid rule. Tell your senator, don't support that provision of the digital asset tax legislation. That's my opinion. Also, related to the big flash crash, some exchanges, in particular Binance, has made an offer to compensate people who experience certain types of losses on their platform. And their intent is, if you lost some assets because your collateral got depegged, that they would compensate you and give you back assets. They're expecting to be giving away $278 million worth of assets to their customers. What would the tax implications of that be? Well, first of all, you experienced a loss or maybe small gain when we had the flash crash. But now, if you are receiving tokens from Binance at no charge to compensate for your loss, that would be considered a gift. It's not income. Even though it's coming from a company, it's not taxable to you. It's a gift, in my opinion, and you would not have to report it. The price at which it was given to you now establishes the cost basis for those coins that you're receiving. So you want to record that, and then when you later sell those, that would be your cost basis. Another interesting wrinkle some people have raised is, hey, can I treat this as a theft loss or a casualty loss because of this flash crash? Some people had money where they had placed stop loss orders, and the stop losses failed. The crash happened so fast, or there was liquidity issues. But whatever reason, the exchange did not act on it, and the asset went much further down before it got sold or went to zero. Whatever the story is, can you claim a theft or casualty loss? Well, losses are a natural part of all investing. So, that's part of the risk of an investor. So no, it's not a theft loss per se. But if you've had a sense of a failure, if there's been basically a casualty loss on your investment, then you have to look at the particulars, but maybe grounds to claim that as a investment loss, which you report and could itemize on your deductions. This would be reported on your Form 4684, Part B, and then it rolls up onto Schedule A of your tax return, which is where itemized deductions are taken. So if it's significant enough that would add to your deductions and you want to itemize it, that would be an option. You should anticipate on those sort of things. There's a higher chance you might get a love letter from the IRS inquiring as to whether this is a frivolous claim that you've made. So you want to make sure you have your documentation in order. Our office would be happy to talk to you about it. But this is an interesting possibility. The nice thing about that is you're not limited to the $3,000 net loss limitation on your tax return that capital gains have. Instead, it goes over on itemized deductions, and you can deduct all of it if necessary. And I've seen people take their entire taxable income down to zero with that sort of deduction. But each person's situation is different, and you should definitely speak to a professional. If you enjoyed this, please like, subscribe, and follow. Refer it to your friends. Appreciate it very much. And keep us in mind as you start thinking about doing your taxes next year. If you have a complex situation, come deal with the #1 company in the US doing full service tax preparation, gain calculation, and defending people in audits before the IRS. Have a great day.